Welcome back. CA Inter Advanced Accounting Amalgamation discussion. The previous parts were done till accounting entries in the books of transferor, and in this video now we'll discuss accounting entries in the books of transferee. Great. Transferee is the big company which has acquired the business of the transferor. So transferee needs to incorporate those assets and liabilities of transferor which it has taken over. Get that? So under this, there are two methods of amalgamation that we discussed previously. Amalgamation in the nature of merger and amalgamation in nature of purchase that will come to use here. So the accounting entries that we're going to pass are going to change at certain places depending upon the nature of amalgamation, whether it is merger or purchase. Rather than discussing them separately, I'll put both the methods one next to the other and then let's discuss it simultaneously. So first we'll discuss purchase method, then we'll discuss pooling of interest method. Purchase method is followed when it is amalgamation in the nature of purchase. When it is amalgamation in the nature of purchase, we do purchase method. And when it is amalgamation in the nature of merger, we follow pooling of interest method. And I hope you remember how to decide whether it is purchase or pooling. We do it based on the 5 conditions. If you've forgotten it, go back to watch part 1 to understand what it is. Very good. Firstly, the business is acquired by the transferee from the transferor. Business is purchased. So that business will involve assets and liabilities. First, we'll write business purchase account. This business purchase is a box received by the transferee from the transferor. This box is called as realization account by transferor. When the transferee receives it, transferee calls it business purchase. The same box which is labeled as realization by transferor is labeled as business purchase by transferee. Such box is received by transferee. So transferee will write business purchase account debit. Transferee will write business purchase account. For purchasing this business from transferor, transferee should pay purchase consideration. To whom? Transferor. Transferee should pay purchase consideration to transferor. Transferor mein business is closed, but the liquidator is there, no? That is the person to whom we should give the consideration so that he will give to the shareholders of transferor company. So business purchase account debit because the business is received. Liquidators of transferor company account debit because we need to give PC to liquidators of transferor company. So what we receive is business purchase account debit, amount payable to liquidator. So we'll credit liquidator of transferor company account. And the same entry, same to same, will appear in the books of transferee even in the case of pooling of interest. Pooling of interest method means amalgamation nature of merger. So first entry is not going to be any different. Entry will be same to same. Entry will be same to same. We'll write business purchase account debit to liquidator of transferor company account. And I put in a nice name here, like you remember that 2019 World Cup wherein all the captains were seated and there was a press meet and they asked, how do you feel? And when it came to Virat Kohli, they asked, Virat, how do you feel about the India-Pakistan clash in the T20 World Cup? And Virat Kohli told, we're all professional cricketers. So outside world sees it as a rivalry and I think for us it's just another match. He spoke for good 1 minute and explained the same. Then came the turn of the Pakistani captain and then he didn't know what to tell. It was complex English and he ended up telling, my answer is also same. Nothing difference. Here also. Purchase method we entry is business purchased account debit to liquidators of transferor. If we ask the entry by pooling of interest method, it will say, my answer is also same like what is there in purchase method. It is not difference. So let's go to the next one. Now that business purchase the box that we received. Now let's do unboxing. Let's do unboxing of this box. When we open this box, from this box, what will pop out? Assets, liabilities, everything will pop out. Will pop out. And the assets and liabilities pops out of this box. Assets and liabilities pops out of this box. What do? We will record these assets and liabilities. So recording these assets and liabilities, Assets are to be incorporated, liabilities have to be incorporated, assets will be debited, liabilities will be credited, and that box will throw it now. That box got empty now, so business purchase account will be credited. See, in this case, under purchase method, the entry will be assets account debit and liabilities account credit. And because the business purchase is now recorded and that business purchase box is no longer required, we'll close it by crediting. Whatever the debit that we had done here now for business purchase, that is closed now here by credit. And we are right now incorporating assets and liabilities. Yeah, this assets minus liabilities is NATO. We take brown. Green. Yeah. See, this assets minus liabilities, whatever is there here, this is NATO. Net assets taken over. Yeah, we make it. It is NATO. And this business purchase, whatever is there here, that my friends is PC. This will be credited to the extent of PC. Purchase consideration. So, whatever the difference between NATO and PC is goodwill or capital reserve. When is it goodwill? When PC is more, credit is more than debit. Then this will become good. Or if assets are more and then money that you give is less, then it will become capital. So goodwill loss, capitalized by debiting. Capital profit transferred to capital reserve. So goodwill account is debited if we pay more and capital reserve account is credited if we pay less. So this is profit. And this is how we account in the case of purchase method. Which method? Purchase method. Goodwill or capital reserve. However, if it is pooling of interest, you are there, I am there. Together when we start, we are one. I am not acquiring your business. It is merger. Amalgamation nature of merger. So I can't make profit or loss. It will be adjusted against the reserves. So we will not be accounting any goodwill or capital reserve. We'll write the same thing. Assets account will be debited, business purchase will be credited, liabilities will also be credited. But we will not be using goodwill and capital reserve account. Goodwill or capital reserve is used only and only in the case of amalgamation in the nature of purchase. Amalgamation in the nature of merger may we will not debit or credit capital reserve. Wherever goodwill will come or wherever capital reserve will come, it will be replaced with reserves and surplus. It will be adjusted against reserves and surplus trade because there is nothing like yours and mine. It is completely ours. Both the entities are together, only one entity. That company is also there, this company is also there. One has not acquired the other. They both have merged. You get that? Next, here the PC is due and the box is open. Now you incorporate all the assets. Now the time has come for you to settle the PC to liquidators. So the liquidators to whom we are supposed to pay, it was recorded as credit here. That is payable. Am I right? See here it was payable. This payable, whatever is there, now will be closed by debiting. We will debit liquidators account. Ouch. I'll explain this entry and then come to debentures. We'll write liquidators entry, liquidators of transferor company account debit, and we'll give them purchase consideration. We can give PC in multiple forms. We can give them equity shares, we can give them preference shares, we can give them debentures, we can give them cash or bank. I told you in the previous videos also, no? It can be settled in multiple forms. If in case there is premium on issue, it will be credited to security premium. If there is discount on issue, it will be debited to discount on issue of debentures. I had mentioned this to you last time in the books of transferor company. I told we should not try to account security premium or discount separately. Why? It is shares of transferee. If someone has to book security premium, someone has to write discount on issue. It is transferee, not transferor. Done. And this PC is given to liquidators, and liquidators will give it to equity shareholders and preference shareholders. But what about debenture holders? People who are holding debentures of transferor company, on the paper that they have acknowledgement of debt, transferor company's name is written. Now transferor company will get liquidated. The paper that they have in their hand is no more valid because it has the name of a company which is liquidated. So they come to me with that outdated paper. I tear that paper and I give them fresh debentures, or I can give them cash, or I can give them shares, equity or preference. I can settle it however I want. For that we need to write the settlement entry. for which my liability what I've taken over, debentures of transferor company, should get closed. So I will debit debentures of transferor company, and I'll settle them by giving debentures in my new company. I can give them preference shares, I can give them equity shares, or I can give them, when I give them debentures or shares, if I give it at premium, I'll further credit security premium. If I give it at loss, I'll debit discount on issue of debentures. Get this? And these two entries, settlement of debentures and settlement of purchase consideration by paying to liquidators, whatever is there, this is same to same in the case of purchase as well as merger, meaning settlement of debentures entry and issue of purchase consideration to liquidators entry will be same under purchase method as well as pooling of interest method. So amalgamation in the nature of merger and purchase are not going to be accounted differently when it comes to debenture settlement and PC settlement. The entry difference will be incorporation of assets. Where if it is purchase method, we write the difference to goodwill or capital reserve, but under our pooling of interest method, it will no longer be written to goodwill or capital reserve. It will be routed to reserves and surplus. Got that? Then, as the debentures are settled, PC review is over. Now we'll go down to adjust few internal transactions. The first thing is realization expenses of the transferor company if it is paid by transferee. See, firstly, realization expenses is for realization of transferor's assets and liabilities. Who should pay? Transferor should pay. If he has paid, he has borne, we will not write entry. But if we are reimbursing the expense of transferor, or if we have paid the expense to realization, in the case of realization, we have incurred expense, then we would have to write entry. Transferee books mein, because this expense is paid, we would have to credit bank account, and the debit will be given to goodwill. Why? We are not receiving anything. So under the purchase method, entry for realization expenses of transferor paid by transferee will be goodwill account debit to cash or bank account. Goodwill account debit to cash or bank account. This is under purchase method. If in case it is pooling of interest method, right here, one moment please. Yeah, the first one is purchase method, and under the next one we do pooling of interest method. Pooling of interest method is when it is amalgamation in the nature of merger, and this is purchase. Yeah, and here we write goodwill account debit to cash because we don't get anything in return, but we're still incurring expense. However, if it is pooling of interest method, we cannot be using goodwill capital reserve account. It will be debited to reserves. So we'll write P&L account or general reserve account debit, and the credit will be given to cash or bank. Got this? Then comes a very interesting case of mutual indebtedness. What is mutual indebtedness? This is before the basic amalgamation or merger happened. Oh, I was wondering, did you guys understand here when I told these two entries is same in this case? So it is same to same. If you remember this movie from Authority Kidare, Pawan Kalyan tells like, okay, see, me and lion are same. Doesn't shave. Otherwise, everything is సుడపా నేను సింహం లాంటి అది గడ్డం గీసుకోదు తీసుకుంటా అంతే మిగతాదంతా సేమ్. That's what it is, like debenture settlement entry and discharge of PC entry is same in the case of pooling of interest and purchase method. Same happens here also. For mutual indebtedness, entry that we write under pooling of interest method and purchase method will be same to same. There is not going to be any difference. But this is Manikya movie picture from Sudeep acted movie. Same thing, movie made in Kannada. Manikya, no? Not Manikya, yes, Ranna. No, don't blast me in the comments, sir. You told wrong movie. No, Ranna. He says no. I am like Jackie Chan. He doesn't know Kannada, but I know Kannada. That is the only difference. Otherwise, everything is same to same. Yeah. What is mutual indebtedness? Before this amalgamation, merger, absorption, external reconstruction is happening, there are two different entities. Then they were trading between them. Transferee is selling goods, transferor is buying goods. Or transferor is selling goods, transferee is buying goods. This transaction is happening. Because of which transferee owes money to transferor or transferor owes money to transferee. Either of the cases. I owe money to him or he owes money to me. Either of the possibilities is there. When either of them owe money to each other, when there are two distinct companies, it's okay. Here debtor is recorded, here creditor is recorded, here bills receivable is recorded, here bills payable is recorded. But when they become one and they prepare one balance sheet, in the same balance sheet, there is debtors as well as credit. There is bills receivable as well as bills payable. So there is bills which I have signed, which is with me, against which I should pay money to myself. I am my own debtor, I am my own creditor. I owe money to myself. There is no point in writing it, no, both sides, asset side as well as liability side. You get it? By this, we'll only increase our current asset and current liability. Total balance sheet asset, total balance sheet liability, both will increase. Balance sheet will tally at a higher amount. Because we are one entity now, we don't have to pay money to ourselves. We can reduce the assets and reduce the liabilities. Yeah, respective asset and liability, debtor, creditor, or bills asset, bills receivable, bills payable. That is called mutual indebtedness. So to decrease the liability, we debit it. To decrease the asset, we credit it. So the entry will be either creditor to debtor, creditor account debit to debtor account, or bills payable account debit to bills receivable account. Have a look. So entry is creditors account debit to debtors account, or bills payable account debit to bills receivable account. So this is for mutual indebtedness. When one company owes the money to the other before amalgamation and they get amalgamated, it will be shown as debtor as well as creditor, asset as well as liability, which has to be written off, which we are doing it rightly. Then we have unrealized profit. What is unrealized profit? I told you, one company has sold goods to another, yet the transferor has sold goods to transferee, or transferee has sold goods to transferee. In either of the cases, one of the party who sold would have booked profits. Meaning if the transferee company is selling goods to transferor, 100 rupees worth goods I would have sold to them at 110. If the transferor has sold to outsider for 115, no problem. Why? I booked profit of 10, transferor booked profit of 5, totally 15 rupees profit, we have earned it. The problem starts where transferee has sold goods to transferor, 100 rupees cost, sold at 110, I booked 10 rupees profit. Transferor didn't sell it to outsider. The stock is with the transferor, and then we go for amalgamation. So now transferor's stock will become my stock. So I have sold stock to myself, meaning stock which is there in my books of accounts now, whose cost is 100 is recorded 110. So I've recorded profit which is not realized. This has to be written off. This unrealized profit can work both ways, upstream, downstream. What is upstream? Upstream is when transferor has sold goods to transferee and transferee has not sold it outside. Downstream is when transferee has sold goods to transferor and transferor has not sold to outsiders. So stock sold by transferor to transferee or transferee to transferor at a price over and above cost, not sold to outsiders and remaining in closing stock, will lead to unrealized profit. Will I repeat? Goods sold by transferor to transferee or vice versa, remaining unsold will lead rise to unrealized profit. Stock is sold between themselves and profit has been booked which is not earned. Such profit has to be reduced and the value of the stock also would have gone up. No, instead of 100 rupees cost, it would be now recorded at 110. I should bring it down to 100. So what do I do? To bring down the value of the stock from 110 to 100, I will reduce it. I will credit the stock and debit will be given to goodwill in the case of purchase method. See, in the case of purchase, we'll write goodwill account debit to stock. Why? I'm reducing the value of the stock and for no reason. Am I getting anything? Getting nothing in return. Sorry. Do you guys understand? We're getting nothing in return, but we're still reducing the value of the stock. So we'll write goodwill account debit to stock account. However, in the books of transferee company, if it is amalgamation in the nature of merger, we cannot debit goodwill account. So in the place of goodwill, we'll debit P and L or general reserve account debit. P&L account or general reserve, free reserve account debit, and we'll credit the stock to reduce the value of the stock. So stock value will be reduced and will not be debiting goodwill, will be instead writing it to general reserve. This is how we account unrealized profit. And the last adjustment is statutory reserve. What is statutory reserve? Now, due to various provisions and laws applicable, a company might be required to maintain certain reserve for a stipulated period. Workmen compensation fund, dividend equalization fund, foreign exchange fluctuation reserve. Some of these reserves, because of the any law that's applicable, government might say by way of statute, this reserve has to be maintained for 3 years. This reserve has to be maintained for 5 years. Such responsibility is there on the company. Company is willing to continue and then do that. And after some 2 years, maybe the restriction is 3 years or 5 years. After 2 years, this company which is maintaining statutory reserve is taken over by transferee company. Now I take over transferor company who's maintaining statutory reserve. Now it was his responsibility to maintain that reserve for 5 years. Now when I take over his business, it is my responsibility to show the reserve now. 2 years already showed, now I should show it for 3 more years. So it's a reserve, so I would have to credit it. So I'll credit statutory reserve account. Debit will be given to amalgamation adjustment. So I'll write amalgamation adjustment account debit to statutory reserve account. At the end of that 3 more years, when it is no longer required to maintain this statutory reserve, what will I do? I'll reverse this entry. Right now I've written amalgamation adjustment to statutory reserve. Then I'll write statutory reserve to amalgamation adjustment and then close this. This entry of recording statutory reserve credit and debiting amalgamation adjustment for the balance period will be done only in the books of transferee company in the case of amalgamation in the nature of purchase only. This is purchase. In the case if it is amalgamation in the nature of merger, that is pooling of interest method when we do entry, we don't have to account for statutory reserve separate. Sir, why? Because when do we call it amalgamation nature of merger? When we follow 5 conditions. That's when we follow pooling of interest. What are the 5 conditions? All the reserves and surplus include, so all the assets and liabilities, including reserves and surplus, is taken over and recorded book value. Let me show it to you. I think I just closed the presentation. It should be there. No, it's not there in this. You guys have seen it, no? All the assets and liabilities, including reserves and surplus, is recorded. So when the transferee company takes over all the assets, liabilities, including reserves, the transferee company has taken over statutory reserve also. So such statutory reserve is already incorporated. Where? This we wrote no second entry here. Assets account debit, liabilities account debit to business purchase. Here we would have credited such reserve. We would have already created such reserve. So we don't have to separately write another entry to record such statutory reserve. Got it, guys? That's it. This is how we account for all the transactions. Then we have mutual indebtedness. What is it? It is when transferor company owes money to transferee company or vice versa. This is all small explanation for each one. What is unrealized profit? Unrealized profit is a theoretical profit or deficit that exists on balance resulting from an investment that has not yet been sold for cash. One has sold the goods to the other, but it is not sold by that party to outside. What we have after that is statutory reserve. It is the amount of money, securities or assets that need to be set aside as legal requirement by insurance companies or financial institutions or by statute also. Yep, that's it. Then once we do this, we'd have to go ahead and then prepare financial statements. But another important thing is the disclosure requirements as per AS 14 has to be adhered, and these disclosure requirements have to be fulfilled in the books of transferee company. What are the disclosure requirements? We should disclose the name and nature of amalgamation. Yeah, we should write the name of the transferee company, name of the transferor company, nature of business of amalgamating company, You should tell the effective date from which the amalgamation will come into force. From what date? Method of accounting followed. Is it pooling of interest method or is it purchase method? Yeah, based on with reasons. And how is the purchase consideration computed and how is it settled? Is it by issue of equity shares, preference shares, debentures, cash? Is it under net assets taken over method or what to say intrinsic value method or lump sum method or payment method? How did you arrive at that ratio for exchange? What is the basis? All of that have to be disclosed. Settlement of debenture holders. How are you settling the debenture holders of transferor company? Are you giving them debentures? Are you giving them cash? Are you giving them shares? Is the issue at nominal value or is the issue at premium or is the issue at discount? All of it needs to be disclosed. Then we should also disclose the valuation of goodwill. How are we valuing the goodwill of the transferor company? Is it under simple average method? Is it under weighted average method? Is it under annuity method? Capitalization method? What is the normal rate of return that you considered? What is the number of years purchase that you considered? How many years of average did you take? How did you decide to take so many years of average? What is the basis? All of it needs to be disclosed. And after this, we have to go ahead and then prepare balance sheet of the transferee company after amalgamation, considering all these entries that we passed just. Got that? And this is the theoretical understanding that one should have to go ahead and then prepare problems on amalgamation. Now I'll show you all of it that we've discussed in a glance so that you can take a quick note or you can pause it and then take a screenshot or update it in your notes. At the end of it is the end of this part 4, and in part 5 when I come down I'll be solving questions on amalgamation, the last two examination questions on amalgamation. Yep. So the first part is here, purchase method and pooling of interest method. Both the methods में what is the entry for business acquired? I hope you took a note of this. Then incorporating assets and liabilities, what is the entry? Along with entry for settling debenture holders. Yep. I hope you took the note of these two entries. Let me now show you the entry for discharge of PC. The first column is amalgamation in the nature of purchase method, and second column is amalgamation in the nature of merger, pooling of interest method. I hope you took a note of this one. Then the next entry is for realization expense, mutual indebtedness and unrealized profit. Note of this please. After this, the next part is statutory reserve. What is the entry for statutory reserve? No entry for statutory reserve in the case of amalgamation in the nature of merger because it would be taken in the initial part. Yep. So the meaning of mutual indebtedness, the meaning of unrealized profit, statutory reserve. This is important. Take a note of this one. This is disclosure requirements as per accounting standard 14. Please do like this particular video, share it among your fellow friends who are writing this examination and who need this. If you think it's of use, also comment and let me know how this video is and how beneficial was it for you in your exam preparations. And if you have any other topic that you would want me to cover, please do let me know in the comments. In the past, I've done liquidation pay part by part detailed discussion in a very crisp manner, and we've done marathon revision for intermediate advanced accounting June 2022 paper discussion, RTP and MTP discussion, and I'll also come out with RTP MTP discussion for the current attempt. If there is anything more that you need, will be there at your service. Use the power of asking, unlock it, ask. Maybe after this, I'll come out with another topic, maybe banking, NBFC, or buyback, any of the topics. Yes, I hope you copied this disclosure requirements. That's it, guys. You guys learned something new today in this video, and I also hope that you guys had a little fun today learning from this. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun, it's all good, guys. The day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So, thumb rule to stay happy is pretty simple, it is to stay in the game. So, for one last time on this day, I have just one simple question for all of you. Are we in the game? The answer is pretty simple. It is we are in the game. I hope your answer is yes, we are in the game. See you all in the next part wherein we'll solve questions from the past examination from the chapter of amalgamation. Till then, tata, bye bye, take care, stay in the game and get lost. Bye, guys.